When I meet with folks in my office and start asking questions about goals and concerns as they approach retirement, I almost always hear something like this. We're really worried about losing the money we've got put aside for retirement with the stock market going up and down all the time. It changes a lot more than it used to. We don't want to run out of money and we don't want to work forever. We want to enjoy life and spend some time having fun without having to worry about going broke. Sound familiar? Did you know that a study done a few years ago found that those approaching or in retirement were more afraid of running out of money than dying? Most people I meet with agree that having retirement income that will never run out is more important at this stage of their life than a rate of return. You know, Will Rogers summarized it really well when he said, "It's not the return on my money, it's the return of my money that matters." In my practice, I specialize in creating retirement income for clients, and often part of that strategy I recommend is using annuities, specifically fixed index annuities, to generate that income. When I bring up the topic of annuities, sometimes I hear, "I don't like annuities. I heard that if your money is in an annuity and you die, you lose it. That's it, it's gone. Or if something happens, I need some of the money, I can't get to it. I don't want that." Those statements aren't true across the board, and I find there's a lot of misinformation out there. So I'd like to spend a couple of minutes discussing the 4 types of annuities, along with their pros and their cons. The first type of annuity is the immediate annuity, and many of you have immediate annuities and don't even know it. If you or someone you know are getting a pension, that's most likely an immediate annuity. See, the company you work for all those years invests money with an insurance company and pays you a pension for as long as you live. But what happens when you die? Well, the money stops unless you've chosen to leave it to a survivor. The second type is a fixed annuity. It's very similar to a CD. In a CD, you put your money in a bank for a fixed time period, and they pay a fixed amount of interest. The insurance industry came out with a fixed annuity about 100 years ago. It's their version of a CD. You give your insurance company money for a specified amount of time, and they pay you interest. Like CDs, fixed annuities are insured. The actual amount guaranteed varies from state to state. An important difference between a fixed annuity and a CD is that you don't pay income tax on the earnings from the annuity, but you do on the earnings in a CD. What about fees? With a fixed annuity, you might ask. There's none, just like there's none with a CD. So how in the world does an insurance company make money if they don't charge a fee? They make a profit by placing your premium dollars into their investment portfolios, which contain investment grade and A+ grade corporate bonds and U.S. Treasury securities. Over time, they must make a profit on these investments. Variable annuities are a third type of annuity and the only ones that have market risk. A variable annuity is an insurance contract in which at the end of the contract they guarantee a minimum payment. The remaining income payment portion of the contract can vary depending upon the performance of the managed portfolio, which is made up of mutual funds. Variable annuities are big business for the brokerage firms and insurance companies. The downside to them is they usually have high fees and include the highest degree of risk of any annuity type. The last type of annuity is the new kid on the block. Though it's been around 20 years, now it's called the fixed indexed annuity. The way this annuity works is when the market index that the annuity is tied to goes up, you get some of the gains. The insurance company usually caps your gains per year and in return guarantees that you will never lose a dime of your principal. Fixed indexed annuities gains do fluctuate depending upon market conditions, but unlike money in the stock market, you can't lose principal. Here's a hypothetical example. Let's say I put $100,000 into an annuity and the index goes up 7%. Now my value is $107,000. Next year the index goes down 10%. My account value doesn't go down, it's still $107,000. That gain's locked in for you. It's locked in once a year or per period your contract specifies. Almost all fixed index annuities allow you to withdraw 10% of your balance every year without penalty, And in case of a medical emergency, disability, or a situation where you would need funds for extended health care, you can usually access all the funds your annuity has without penalty. Tom Hegna is a well-known international economist, author, speaker, and he's written a terrific book that I commonly share with clients called Don't Worry, Retire Happy. The book was highly regarded by financial advisors across the country, and it was made into a PBS special by the same name and can be seen in many markets across the country. In it, Tom enthusiastically recommends fixed indexed annuities as a critical tool in protecting retirement assets and using them to provide guaranteed income. Tom's been a guest on my radio show several times over the years, and we've discussed fixed indexed annuities quite a bit. In his book, he states that he himself owns a fixed indexed annuity as a part of his overall retirement plan because of the strong safety of his funds. So let me ask you, are you at the point in your life where you're looking to protect all or some of your retirement assets from market risk? Are you interested in strategies that can accumulate interest and provide a death benefit, but will never lose principal value? If you answered yes, then it may make sense to develop a strategy that uses a portion of your nest egg to generate income through an annuity. Annuities make sense if you want to take risk off the table. I'd welcome the opportunity to sit down with you to explore whether this option makes sense for your retirement plan. Call my office or go to the Contact Me tab on this website to schedule a complimentary, no obligation review. And if we determine such products make sense for your needs, we'll discuss all the terms in depth. I hope this information has been helpful, and I look forward to meeting you soon.